also part of their own effort. It will have meant that they've increased their productivity, because the business will not be making profit without the effort of the workers. So workers might claim an increase in wages based on the fact that they have figures that state that the business is making profit. Do you understand the interest of employees now? The interest of managers is the profit made, which increases their performance, or which reflects on their performance. Managers can also use that to even ask for more wages too. Do you understand? And for employees, they might use the statement of financial position or the financial statement to discuss wage negotiation. Is it clear, please? Yes. The second internal stakeholders are the owners and shareholders. Owners of the business, we know them. They have put money into the business, especially for small businesses. They are keen to see the business performing well, because if the business performs well, it means return on their own investment. So it's a reward for them if the business is doing well. So they are keen to see the statement of the financial statement of the business, because the financial statement of the business will reflect on the profit made by the business. So owners of the business will always want to be sure that their financial statement is intact, because it shows them the progress they have made in the business, and it's the reward for them for investing so much into the business. Do you understand what owners say?
Yes.
For shareholders, they buy shares in the business, so they have invested into the business. So what they want is return on their investment, yes or no? So the only return they will be able to get is if the business is making more profit, because if the business is making more profit, it means more dividends to them. Dividends is the share of profit. Profit has to be distributed to shareholders, because as a shareholder, whenever you buy the shares, the amount of money you pay in buying those shares are permanent capital. You don't get them back. So the money belongs to the company. What you get back in return is a dividend. Whatever amount of shares you buy, the capital is permanent. It stays with the business. So the business will have what? The profits made by the business allows you to have dividends. So dividend is the share of profit distributed to owners, to shareholders. Do we understand shareholders here? So their interest is the business making more profit, because more profit made by the business means they're going to have more dividends to them, and it increases the value of their shares. Do we understand? Do you understand this?
Yes.
Then we have external stakeholders. Why do we call them external stakeholders? We call them external stakeholders because they are not directly involved in the business activity, but they have interest in the business too. Examples are the banks. You know what the banks are? The financial institutions that save your money, that give you loans and the rest. So the banks, why do they have interest in your financial statement? They have interest in your financial statement because they want to be sure that you are not owing a lot of debt. They want to know your work. They want to know if they can access, you can have access to their loan. So for banks, they will not just give you money, or they will not just give you a loan. They want to be sure that you can pay back the loan. And how are they going to be sure that you can pay back the loan? They check your financial statement. Because your financial statement is a true reflection of your company. So if your company is doing well, it has to be reflected. It has to reflect in your financial records or documents. So banks will use your financial statement to decide if you can access a loan with them or not. Do we understand?
Yes.
So banks, they want to be sure that you are not a high risk. A high risk is a business that is on it, that they feel it cannot pay back the loan. Is it clear, please? That's for banks. Then we have suppliers. Who are your suppliers? Your credit payables, your credit suppliers. You buy from them on credit to pay at a later date. We call them trade creditors. Why do they have interest in your financial statement? They have interest in your financial statement because they want to be sure of your credit worthiness. So if they are giving you, if they are selling to you on credit, if they are supplying to you on credit, they want to be sure that when the day is due to pay, you'll be able to pay back. How are they going to be sure? They can only be sure with your financial statement, which reflects your well-being as a business. So financial statement is used because you have the liquidity. They want to be sure that your current asset is more than your current liabilities. That means you have enough liquidity. But if you don't have enough liquidity, then how would they be able to give you a credit sales? How would they be able to supply you on credit? Because if they supply you credit, it means they're not getting the money right now and the stock is out of their business or is out of their premises. So suppliers also want to be sure that a business will be able to pay back its invoices as at when due. An invoice is a document stating that you bought certain goods on credit to pay at a later date. It's not the same as a receipt. A receipt is an evidence of payment. It's different. So when you buy on credit, you'll be issued an invoice. But when you buy by paying cash, you'll be issued a receipt. Do you understand the difference between a receipt and an invoice? Yes. A receipt is an evidence of payment. An invoice states that you are owing for certain goods that you have purchased to pay at a later date. Is it clear, please? Yes. Lastly, financial statements of public limited companies are published to inform stakeholders about the performance of the business. Here, we're going to talk about the financial statement. Why do we publish it? We publish it because we want to inform our stakeholders how well we are doing, how well we're performing in the business. It allows the investors to know if they can invest more in the business or not. It allows the banks to know if the business will be able to pay back its loan or not. It allows suppliers to know if the business is creditworthy or not. It also gives the government the opportunity to know if the business is paying the right tax or not. So these are reasons why we have financial documents, and these are the people or group that need the financial documents. Thank you.